Welcome to our new series, Fundamentals, a platform to understand your fund tenets. In this series, we aim to bring to you the minds behind the funds you may have invested in. Today, we discuss Kotak Balanced Advantage Fund. This fund runs on the principles of dynamic asset allocation. It has an assets under management of around 14,000 crores and has generated a 9.8% return since inception. Coincidentally, as we speak, the fund celebrates its fourth year anniversary. This fund is being co-managed by Mr. Abhishek Bisen and Mr. Harish Krishnan. Abhishek and Harish, many thanks for joining in and talking to us in details about this fund. My first question to you is, every fund manager has his or her unique style. What would be your style and approach to investing in general?
So I guess styles do evolve over a period of time. So I've been in markets for the last 18 years, and I think over this evolution, some of the areas where we have fine-tuned our style is primarily to focus on growth and quality at a reasonable price. So we are looking at growth-oriented businesses, but we don't want to overpay for them, because ultimately overpaying significantly for even good quality businesses, one does run into a risk of making losses. The second thing is over a period of time, focusing on lesser mistakes has made us possibly get or have a higher success ratio. So do little, but in what we do, we need to have a far greater insight into why we are doing something and making less mistakes. I think those have been the key areas where we've nudged over the last 2 decades or so. Abhishek.
Yeah. So, as far as fixed income is concerned, largely we follow a philosophy, but with the philosophy, we need to keep in mind the objective of the fund we are managing. So, different funds will have a different objective while keeping the philosophy of safety first, followed by liquidity and return. So, keeping this in mind, since this fund we have primary driver as asset allocation and equities, the remaining part comes to fixed income, and therefore we just make sure that we keep on consistently giving reasonable carry risk adjusted return, which is not too volatile. So we just try and control volatility with good quality and liquidity. So that is what we are just consistently focusing on, maintaining that, ensuring reasonable amount of rate which is commensurate with the risk return perspective, and just make sure that the volatility is the least, and we keep on supporting the equity part with the fixed income piece.
So, Abhishek, you mentioned about minimizing volatility. So, which investor segment is this fund best suited for, or it is intended for rather?
Yeah, so segment as such, I would say any person who typically we keep getting this question that what is the time we should book profits or when we should enter. So according to us, there is no perfect time for booking profit, because eventually we are in a developing world and markets, we have seen good crashes and tops, and eventually keep beating the tops and on a continuous basis. So one, A, you should follow an asset allocation, and B, since you are unable to time it, so just leave it on to this particular fund where we have it on an automatic basis based on certain fundamentals. The fund will do it for you in terms of asset allocation between debt and equity, and you don't need to bother about whether we should book profit or cut losses and vice versa, and just make sure that the consistency in wealth creation is there over a long period of time.
So, just to take it a little forward, what would be the ideal time horizon and the return expectation from Kotak Balanced Advantage Fund?
So from our perspective, clearly this is an equity-oriented product, right? Therefore, a minimum horizon would be of 5 years plus, wherein the probability of having adverse outcomes is limited. I won't say it ever gets out, but you want to try and play the odds in such a way that the odds of having adverse outcomes is very low. And that we think at least having a 5-year horizon makes it. The in terms of return expectations, now obviously this is a product which moves its net equity from say 20% onwards to 80% in general cases, and sometimes in very rare cases maybe even higher. But broadly, when we say that this is the range that we move to, the idea is that we need to give or the investor kind of experiences, as Abhishek said, an automatic rebalancing. But more importantly, what we have seen is that in 5-year horizon, the typical or the minimum returns that we've seen in a back test, of course, these are back test, future returns may vary depending on markets and scenarios that come through, has been that the lowest return has been that of an FD at that point of time. So in some sense, that becomes like a reasonable threshold to have. On the upside, if you look at an FD, typically, especially if you put it in, say, a nationalized bank, as most Indian households do, in today's rate, it might take maybe 15, 17 years to double their money. In the case of Kotak BAF, again, through the back test, what we've seen is that it typically doubles anywhere between, say, 6 to 9 years. Now, again, these are back tests. I have to keep repeating this, but that gives you the range that at the minimum on a 5-year horizon, returns would be similar to that of an FD. But the upside is a faster compounding compared to that of an FD that otherwise most Indian households would put most of their money into. So that really is the return expectations that investor and the horizon that investor needs to expect.
If I can just add on to it, in one line, if I have to say that, what I've observed is you have a downside risk of any duration fund in debt side, while upside is almost, let's say, 80% participation in equities. So with that kind of balancing or equation, I think it makes a fantastic product, one-stop shop for people who can't dabble on themselves when they want to put out from equity and to go in debt and take out of debt and go into equities. Just to put it on one stop. So anybody who has 2-year and above investment horizon and is okay with that kind of equation, I think can look for this product.
You spoke about automatic rebalancing, and this is, something you and Harish very often speak about. So, when we look at this fund, should we look at it from a absolute return perspective or from a relative return perspective? Because it is, why you mentioned it is an equity-oriented fund, and equity-oriented funds have a, benchmark to go to and assess. But how do you assess this kind of a fund?
So absolute, I will say nothing is absolute in our world because we are not targeting anything absolute per se, but we are just targeting that we should be able to protect your capital on a, let's say, 2 to 3 year basis, or as Harish said, 5-year basis minimum is what an FD kind of return would have given. But what my observation is in a, let's say, 2 to 3 year cycle, also very minimal time it would have happened that you would have gone, your capital would have sort of eroded. So marginally, whatever number it would be. But on that basis, you're keeping your capital at certain level, which is sort of a risk-free rate, and with an upside, which whatever the market would have been giving. So you just need to protect your investment from inflation-adjusted return. So since equities typically do that, so that I would expect it that way. So I would not target anything absolute. Let's say a 10% can be as bad number, and a 2% can be as good number, depending on how the relative world is doing. So I would look at that way.
And if I can just add, the analogy is not so much absolute relative in our minds. It is just like we have in Mumbai, the slow local, fast local. I think that's the analogy that we keep giving, that, with debt, obviously it is a slow local, but you've got a greater confidence that you'll reach. It might take a lot longer. Equities is the fast local, but then if you are in an overcrowded equity zone or an overcrowded fast local, the general experience isn't that nice, and therefore people out of frustration might not choose to go on the train journey itself if that was the only option. So it is for those set of investors which want the reasonable I would say experience of the slow local, but there are points and opportunities that come wherein it makes sense to move and board the fast local, which is to move on to the equity platform, because that is where faster wealth compounding can happen. And that is where actual wealth creation can happen ahead of inflation. So I would put it in that analogy rather than the absolute relative.
That's a lovely analogy, Harish, as always. Abhishek, my next question to you is that if I look at this fund, there are three moving parts to it. You have asset allocation, you have stock selection, and you also have fixed income. Which, would be the pecking order of the importance of these three moving parts?
I would say I'm a big fan of asset allocation. So, see, primarily it is dabbling between debt and equity. So, asset allocation is the key because we are able to, the model is able to assess the risk and return matrix and accordingly give an allocation which asset you should be overweight on from a perspective of future returns. So, asset allocation is the key, and both the assets are able to justify their on a medium to long term basis the risk reward dynamics and able to deliver reasonable return over a period of time on a composite basis.
Harish, my
Absolutely.
next question to you is, quite often we often get asked this question, how do you assess the performance of a balanced advantage fund in various market cycles? So, would you like to explain us that?
Yeah, so this is a fund where one can make returns from 3 or 4 different places, and like Abhishek said, asset allocation. People can have, or different funds can have different asset allocations. Different funds can have different models. The ranges of equity or debt itself can be different for different products, right? So one variance is going to come from asset allocation. The second is going to come from equity and the style of equity that you're running. Are you a concentrated equity investor? Are you a diversified? Are you looking at, say, just as an example, if Nifty is going to give you 10%, are you looking at, say, 11, 12%? Or are you aiming for 15%? Because if you're aiming for 15%, you should also be prepared that you may get a 5% kind of a thing at some time frame, right? It kinds of evens out. The third variance is going to come from the fixed income, wherein are you going to play the credit space? Are you going to play the duration space? As well as the varying other products and structures on hybrids that are there as far as fixed income is concerned. And last is arbitrage. Now, given that there are so many moving parts, typical point-to-point comparisons, I think, are misleading because one can get returns through any of these 4 things. So the way I would look at assessing a product like this is what is the repeatability of this performance. Okay. Now, so to assess repeatability of performance, possibly one method that we can look at is the following, which is the upside capture ratio and the downside capture ratio. That is, when markets are going up, how much does the model by and large capture, and when markets go down, by and large how they capture. And obviously over cycles and over multiple episodes, you will get to see a stark difference between funds which use asset allocation as their primary tool to generate returns, because as Abhishek rightly pointed out, in this category, bulk of the returns on repeatability would come from asset allocation. You can get lucky through some calls on equity, you can get lucky through some calls on fixed income once or twice in a cycle, but to get repeatability, you need to get that asset allocation, the big picture call, more right than wrong. And therefore, the upside downside capture in some sense gives you that. The second thing that people can assess would be that, let's say Nifty was at 18,000 levels, it comes down to 16,000 levels and back to 18,000 levels, right? Now, firstly, how soon does the fund go back to its highs? In the sense, because this is an asset allocation, or the experience of the investor is also equally important than just returns. So if let's say from the previous high to now, for example, Kotak BAF, in current circumstances, Nifty is still to reach its all-time highs, whereas we are already at its all-time high as far as the product is concerned, which means that we've fallen lesser in the downside and we've been able to capture relatively far higher on the upside, which means therefore that we have moved into as far as asset allocation. So the more such episodes one can demonstrate that, one will have a better experience in terms of their ride in this journey of wealth creation. So these would be the broad 2 ways I would look at in terms of assessing how one balanced advantage fund performs over a cycle compared to others.
Harish, my next question to you is that there are over 25 balanced advantage funds in the industry. Now, while I look at your fund, you do a daily rebalancing, whereas there are others who do not do the rebalancing this frequently and some don't do it at all. What are the pros and cons of your strategy?
Sure. So I think it is also a function of what are the variables that we choose. Okay, and as you are aware, all of these peer funds that we have, all of them have a model to guide their overall asset allocation strategy. Now, if you use a fast moving variable, like say 200-day moving average or a 50-day moving average, whatever be a technical indicators that you use, they are generally much faster than say looking at say 5-year rolling returns of Nifty. So just to give you an understanding, a 5-year rolling returns of Nifty to move from say 12 to 14% means markets have to go up by 10-12% for that number to go up, all everything else being the same. Whereas to move from say 50-day moving average up to down, it can happen even possibly in less than a week or maybe even a day if markets are extremely volatile, right? So the way we look at it is we look at two broad factors. The first factor is long-term valuations, which is of the top 100 companies at any point of time. We look at the earnings yield, that on a trailing basis. So again, this doesn't change every day. It changes with quarterly numbers. It changes as market moves up, etc. Right? So that is one. It's a long range indicator. The second factor that we look at is sentiment. Now, sentiment, while it is a nebulous, wishy-washy kind of a word, we have tried to quantify it through four factors within that. The first factor is rolling returns. Like I said, it's again a long-term rolling returns of 5 year, 7 year. Another thing that we look at is short-term rolling returns. Whenever markets fall significantly, we want to see if we can reverse it. The third that we look at is the breadth of the market. So out of 1,000 stocks, if say 700, 800 stocks are close to 52-week high, we know that there is too much greed or vice versa. And then we look at VIX measure. Now, the point of me detailing out each of these factors is to give you an understanding that each of these factors don't change on a daily basis. They take time. I mean, the markets and the market structure have to change quite meaningfully for it to have a change. And then the interplay of all these 4-5 factors together decides whether we move. Now, why do we therefore do it on a daily basis? We do it because the opportunities that come through are very quick and fast, right? So when we have got long-term, slow-moving indicators as our input variables, whenever they do change, we need to be quick to change, right? So while we rebalance or while we run the model on a daily basis, so broadly what we've seen is there are 250 odd trading days in a year if you leave out the holidays, Saturdays, Sundays, etc., right? Out of 250 odd trading days, while we run it on a daily basis, the actual model changes only 30 to 40 days. But our point is when it changes, we need to be quick to do it. We can't then wait for another 15 days or quarter end or expiry to implement those changes. So given that our input variables are long term, we want to therefore try and optimize it on a daily basis as far as running the model is concerned.
Especially because we bought the term team, Abhishek. When we talk about Kotak Balanced Advantage Fund, you and Harish, are the faces. But who are the other members in your team, or how well are you supported by the analyst in managing this fund?
Okay, so I think it's a overall a very large pool of team, right? So on equity side, we have now got 14 analysts. They support all our funds. So our fundamental picks that come in the form of net equity is determined by their views, our views as fund managers, and it's shaped. And if you look at the net equity level, we churn like say 20-30% in a year. So it's not that, so these are very reasonably well thought out names. It's not to say that we don't make mistakes, but the idea is that give time for businesses to execute their plans. We are not something that is wanting a very quick outcome. We are patient investors. So in the overall scheme of things on equity, we are very well supported. The average tenure of our analysts have been more than 7-8 years in our firm. Most of us have been in the firm for like 10, 15 years. I think both of us have been there for, I think, 15 plus or 20 years,
15 plus
15 plus years. On the arbitrage side, which is, I think, a very key aspect of this fund, because this is a fund that seeks equity taxation. And therefore, whenever we are below 65%, we need to take arbitrage positions. And that is done by our colleague Hiten, who runs India's largest arbitrage fund. So we're very lucky that he also manages Kotak Balanced Advantage Fund and our other hybrid funds. And on debt, again, we've got a very strong team, both on sovereign paper as well as on credits. While in this fund, we generally don't take any credit exposure, primarily restricting it to the sovereign paper and very, very high quality credit. But again, it's supported by a very high tenure of professionals that have been with us for very long. So I think we have reasonably very well supported as far as the overall team is concerned.
Just to add to it, we have 3 people who are on the research side and 3 on the dealing side, and then I'm there. So we are reasonably well equipped to cover up the entire space, whichever is applicable to this part of the fund is concerned.
Thanks, Abhishek, and thanks, Harish. It was indeed very insightful and a great learning experience, not just for us, but I'm sure it is going to be equally enriching for our investors. Thank you so much for taking our time on a busy day. Thank you.